Today's focus. Major players are adjusting their positions. After breaking below the average price, losses are approaching 30%. Will the bull and bear trend reverse? Is Bitcoin really going to plunge toward the $40,000 mark? Ethereum has suffered a double blow. Will institutional faith be completely shattered? It's Wednesday, February 4th. This is the Chinese Bitcoin channel, Bitcoin Hezan. I'm Mike. Let's first take a look at the most important data summary from the past 24 hours in the crypto world. A very critical signal has recently appeared for Bitcoin. For the first time, the price has truly fallen below the market average price, which is around $80,000. This is the first time since October 2023 that we've seen a structural weakening. So we can treat this line as the average cost for the entire market. When Bitcoin is above 80,000, most people are making money. Once it falls below, it means a large number of positions are starting to show floating losses and risk appetite will naturally decrease. In the past, this kind of situation was just a short-term fluctuation. But after the breakdown in 2022, the market went through a very long period of deleveraging, turnover, and grinding consolidation. The price dragged all the way down to around $15,000. And only after new buying and a new cost center slowly formed did the market begin to recover. So right now, this signal is more like a reminder that the market phase has changed rather than telling you that the bottom has already arrived. Until the price returns to this average line and is able to push it upward, the market is still likely to remain in a state of consolidation and under pressure. At this stage, it's not about who is quickest to catch the bottom, but about your patience and risk control. Right now, there's a particularly striking number on-chain. The proportion of Bitcoin UTXOs in a loss has climbed to the very familiar range of 27% to 30%. Why is it familiar? According to historical experience, this point is not a signal that things are about to end immediately. It's more like a pressure gate to see whether the market will continue to be hammered. 30% is a very sensitive line. If it stays above that level for a long time, it means more and more positions are at a loss, and the market is especially prone to a continuous decline. But if the market holds up in this area and gradually pulls back, it means all the necessary stop losses have already been triggered and the panic has been digested. In other words, right now we're not judging whether it's a bull or bear market, but rather testing how much pressure the market can withstand. Whether this line will be broken through upwards or pushed back down will basically determine the direction of the midterm structure. Alright, let's take another look. In January, what routes did the major Bitcoin holders take when moving their coins? Throughout January, a total of 756,000 Bitcoins were transferred from wallets to exchanges, which is clearly higher than in December. Among them, Binance received 188,000 coins, Coinbase took in 175,000 coins, and Bitget got 48,000 coins. The flow is highly concentrated on the top platforms. However, moving coins into exchanges does not mean they are immediately going to dump them on the market. It is more like a unified rebalancing and shifting of positions at the beginning of the year, while also preparing ammunition for derivatives hedging. After entering February, this concentrated inflow has clearly cooled down, with only an additional 137,000 Bitcoins added so far, indicating that the peak of the migration has already passed. At present, it looks more like a repositioning adjustment rather than a panic-driven exodus. As for whether real selling pressure will develop later on, we will continue to monitor the price movements and subsequent net flows for you to see which direction things are heading. Please like and turn on the notification bell. After organizing the data, let's take a look at the major news that has happened in the Web 3.0 world over the past 24 hours. It's often said that you can't earn money beyond your understanding. Watching the news to improve your knowledge is a necessary option, so just turn on the notification bell and glance at the headlines and you'll know what's happened in the past 24 hours. Alright, let's look at the news. Right now, the entire crypto market is in a pullback and everyone is asking, when will it bottom out? When is the right time to enter the market, right? If we only look at the technical side, just the candlestick charts, you might think this is just a normal correction. But the real turning point in the market never shows up in the charts. Everyone saw Bitcoin first break below 75,000, then drop to 72,000, which basically shattered everyone's psychological safety line. But what's even more intense? On Polymarkets, the probability prediction for Bitcoin falling below 65,000 in 2026 has surged to over 70%. This means that nearly $1 million in real money is being wagered on when the worst moment for the crypto market will arrive. But right at this moment, the price is still steadily approaching the cost lines of institutions like Strategy. That's why the market is starting to realize that this round of stress testing isn't just about the price, it's also about whether these institutions will continue to hold on to their beliefs.
The trigger for this sentiment shift was a technical breakdown. Bitcoin fell below its 365-day MA, a key bull-bear line. This led tech and quant funds to passively cut positions, sparking a chain reaction. Meanwhile, hawkish Fed expectations and heavy Treasury issuance drained liquidity, squeezing high volatility assets.
I think the crypto market is taking it much worse than we expected.
Generally speaking, a Bitcoin winter lasts 12 to 18 months, and these are well understood technical characteristics. So from 76,000 down from 125,000, which was the peak, we could see it drop to 40,000.
The deeper divide in the market isn't about price, but about perception. Some people believe in sticking to Bitcoin as an independent monetary system and think we shouldn't just focus on price targets, while others are still betting on its ups and downs. Prediction markets reflect this split. There's a 70% chance Bitcoin falls below $65,000, yet 54% bet it hits $100,000 by year end. These narratives conflict.
Actually, over the past 2 years, as we've tracked the evolution in our daily reports, when it comes to shifts in perception, people have always used a very simple story to understand the crypto world. As long as institutions come in, the bottom is set, right? This story is supposed to take off and the liquidity will be released sooner or later. The institutional coastline is everyone's bottom line. So this current market downturn has directly broken all three of these assumptions. Now, Bitcoin has shifted from being a highly volatile gambling tool that would immediately surge with any emotional trigger to a high barrier capital asset that not everyone can afford to play with. These days, what matters with Bitcoin isn't who shouts the loudest or how strong the consensus is, but whether your balance sheet is solid, whether there's hot money consistently willing to buy from you, and whether someone is willing to take on your risk. And now these two ways of operating are starting to go their separate ways. On one side, people are still following the bull market playbook, making a living off volatility. On the other side, things have already shifted to a capital-driven logic, setting timelines, structuring deals, calculating cash flows, and figuring out how to survive the cycle. So, from now on, when we talk about long-term holding, it's not just about hoarding and stubbornly refusing to sell. You have to factor in financing, hedging, and settlement. Only then can you really consider whether you can make it through this bear market. To put it simply, before, it was all about guts. Now, it's about whether you can last long enough and whether you still have your chips in hand. All right, having talked about Bitcoin, let's take a look at the runner-up, Ethereum. Ethereum is still often described as mud that can't be shaped into a wall. A while back, when Bitcoin broke through 120,000 and hit new highs, Ethereum barely moved. People said it was just pretending to be asleep, right? Now that the market has turned, well, Ethereum is dropping faster than anyone else. Those big holders who stubbornly stuck with Ethereum were hoping to catch some gains from a rebound this time, but what did they get instead? A supplementary drop. So now, the issue with the price is that people's confidence in Ethereum might be a bit lacking. And now these major bulls are all being roasted over the fire, and their portfolios look absolutely miserable. So today, let's take a look at the top 3 Ethereum bulls and see if they're really staying calm or just putting on a brave face.
As the publicly listed institution with the largest Ethereum holdings, Bitmain owns 4.28 million ETH. With an average purchase price of $3,880, they are currently facing an unrealized loss of about $6.68 billion. Although the staking model avoids liquidation risks and has received support from Kathy, Wood has counterattacked by increasing her holdings in support, but with prices remaining below the cost range for an extended period, the core pressure has shifted from the risk of liquidation to whether they can withstand the prolonged drain on capital and confidence.
I think part of it is the crypto industry doesn't have any leverage right now. It's sort of delevered in October, and now when we have gold and silver doing so well, especially at the start of the year, that created FOMO. And that was like a vortex sucking all risk appetite towards the precious metals trade. So I think crypto has suffered from that on a price basis, at a time when the fundamentals have been good.
In contrast, trend research under Yilihua has fallen into a high-leverage drawdown predicament, being forced to reduce its holdings by 18%, on top of a $554 million floating loss. If ETH drops to the $1,685 to $1,855 range, the remaining positions will trigger systematic liquidation. At the same time, Bitforex founder Jared Kim was completely wiped out in the recent volatility due to a $222 million forced liquidation, with his asset scale basically reduced to zero, making him the most direct casualty of this round of ETH correction.
So as you can see in this round of Ethereum's pullback, the market has actually done something particularly ruthless. It has shattered all 3 of people's illusions, that ETH would automatically catch up, that institutions would always bail you out, and that simply waiting longer would solve the structural problems faced by institutions. For example, those like Bitmain who haven't used leverage can hold out the longest relying on cash flow, but those who are leveraged hit the wall immediately. So can Ethereum's price take off again in the future? Don't forget, Ethereum has a Fortzaka upgrade this year. What exactly is this upgrade for? So it's about bringing value back from layer 2 to layer 1. If you ask me whether I have confidence in Ethereum, I'm very confident. As for what the Fortzaka upgrade is, there will be a dedicated episode about it in the future. After watching that episode, you'll have a much deeper understanding of Ethereum. If the competition for computing power on the ground gets too intense, then let's just send supercomputers into space. What do you think? Musk's vision might just blow up the entire universe. Binance spent $1 billion to buy the dip in Bitcoin. Is this a move to support the market, or just for show? Elon Musk has made another big move recently. SpaceX and XAI have merged. After the merger, the combined valuation of the two companies has reached $1.25 trillion. So on the surface, this looks like a combination of AI and super aerospace technology. But if we look at it from an industry perspective, this is actually a much more pragmatic assessment. Musk has long said that the current approach to computing power on Earth is being choked by issues like electricity, cooling, land, and regulatory approvals. That's why the tech world is starting to look upward. There's a massive nuclear reactor in space, and the cooling costs are so much lower, so why not move mining operations into space? So this is no longer just a shift in visionary storytelling. It's a high-stakes gamble that pulls engineering, capital, and compliance into the risk zone all at once.
Musk's core goal is to create a closed loop around space data centers by integrating rockets with satellites, AI, and space-based internet. Last year, SpaceX had revenues of about $13 billion, with Starlink contributing $9 billion, and XAI has already invested around $25 billion in building tangible supercomputing power. The merged vision is to send computing power into orbit, bypassing the bottlenecks of ground-based electricity and cooling. But real-world risks remain. Some revenue is hard to audit. Ground-based computing assets could be replaced by their own technological path, and whether the technology and finances can be sustained in the long run is still a key question.
It's literally about inference, running AI models, and the idea of having data centers that are literally satellite form factor in space. SpaceX builds them, has the capital to buy the GPUs, which it plans to raise from the IPO, and XAI makes use of that compute capacity because it is energy efficient and there is minimal latency in getting the results of running that model back down to Earth. That is the rationale.
Recently, XAI has been recruiting cryptocurrency finance experts to strengthen its models and enhance its practical capabilities in on-chain DeFi analysis and quantitative trading. This move is not just a short-term experiment, but an attempt to enable AI to directly understand the on-chain economic structure, showing that top AI companies have already included the crypto market in their long-term research and application plans. The integration of AI and digital assets is becoming increasingly systematic.
So think about it carefully. Regardless of whether Musk's plan sounds crazy, if it does succeed, could it completely reshape the power structure of AI? Previously, AI computing power was grounded and land regulations could easily choke it. But now, if it goes to space, it becomes a game of who has more money and can reach the skies. The competition is no longer about who writes the most impressive models, but about who can control the AI's lifeline through physical hardware over the long term. So this also perfectly explains why XAI is now suddenly bringing on-chain encrypted economies and payments into one direction, decentralized settlement and cross-regional value flow. This is inherently aligned with the nature of their space-based computing centers, which is to transcend any form of sovereignty. So to put it bluntly, this isn't an upgrade in computing power, but rather an early move to secure a strategic position. It's no longer about which AI runs faster, but rather AI has shifted from just writing code and doing tasks to a capital-burning war, desperately building infrastructure. In the future, the barriers to entry in this field will be ridiculously high, with very few winners, and those who lose may not even leave a single word behind. Now that the market is weakening, people have become very pragmatic. It's no longer about how much prices can rise, but whether anyone is actually willing to put real money on the table and buy. So for exchanges, their stance is no longer expressed in words, but is written directly in their ledgers. SAFU was originally meant to be a safety cushion against black swan events, and for a long time it was filled with various stablecoins. The idea was to crouch down and stay still, to take a defensive stance first. But when prices keep hovering at low levels, confidence, especially the confidence of exchanges, gets gradually drained away, bit by bit. So now, if we see someone moving, say, FU, it's not just a simple portfolio adjustment, it's making a public statement. In a bear market, the question is whether I should stay curled up or be the first to stand up and become the last buyer.
Recently, Binance announced the largest adjustment to the SAFU fund since its inception, planning to convert about $1 billion worth of stablecoins into Bitcoin in batches over 30 days. The first batch finished Feb 2, using $100 million to buy 1,115 Bitcoins at 76,800 TAL to 77,773 TALs each. Binance promised if the fund drops below 800 milers due to volatility, they will replenish it to maintain the 1B scale.
So everyone, take a closer look at this news. Safu has converted all its stablecoins into Bitcoin. What kind of strategy is this? It means that the top experts are now using emergency funds to take long-term positions. This basically provides the market with a solid buying force. That's why people are more willing to believe that Bitcoin is the gold bar of the digital future. Plus, that big player said they'll top up the fund if it drops below $800 million, right? So now everyone feels more reassured. If things really crash, there's still someone backing it up. Of course, that doesn't mean Bitcoin will immediately shoot to the moon. After all, it's a volatile asset with a big temper, and if it drops too much, even the big players will feel the pressure. So this isn't just some short-term pump slogan. What the big players are really telling you is that they're already in on this round, and their stance is clear. All right, let's get to it quickly.
Tether's latest fundraising round basically hit the brakes. They originally aimed to raise $15 to $20 billion, but now they've cut it down to just $5 billion. To put it bluntly, investors just aren't buying into their $50 billion valuation claim. It's not that no one is willing to invest, but at this price point, people feel it's a bit inflated. They'd rather wait and see if the stablecoin model can really support such a massive scale. Gold shot back above $5,000 in one go, reaching as high as $5,058, a 2.26% increase in just 24 hours. Silver was even more aggressive, surging to $88 with a single-day gain of 3.28%. When the market feels increasingly insecure about liquidity policies and risk expectations, assets like gold and silver, which may not tell a story but can withstand crises, are once again brought back into the spotlight. X suddenly added a little rocket to the like button, and designer immediately called it out by name. This whole thing just doesn't seem like a coincidence. Just as news broke about the merger progress between XAI and SpaceX, the platform suddenly launched a rocket feature. It's hard not to suspect this is a classic Musk-style Easter egg teaser. Suddenly, there was a major move on-chain. A single USDT was quietly transferred out of Binance, and its destination remains a mystery. With stablecoins of this scale making moves, it's almost impossible for the market not to take notice. In recent years, the crypto world hasn't just had to guard against hackers, but also threats from the real world. In 2025, there were 72 wrench attacks targeting coin holders, a 70% increase in just 1 year. This shows that while the blockchain itself is very secure, people have become the bigger risk.
Now, what do most people think when they hear institutions are entering the market? A price pump? But the truth is, institutional entry often signals a market slowdown. Institutional money doesn't chase price surges, so don't worry. What are they after? They want structure. They enter slowly, add to their positions in batches, hedge their moves, and calculate across cycles. What you see is a price breakout, but what institutions see is whether there's anyone willing to take the other side of the trade. Retail investors or newcomers are most likely to make the mistake of using a moonshot mindset to interpret how capital is being deployed. Do you really think institutions show up just to drive up the price for you? But more often, they're here to test the waters, to see how many people are still in the market. And when emotions are running highest, institutions quietly hand off their positions. Remember, institutional entry isn't a bull market signal, it's a stress test. Institutions are never here to make you rich, they're here to find out who will take on the risk for them. The real big money isn't made in that moment when things take off, but in the entire stretch of the cycle that you can't see and can't wait for. If you get it, give this a like. Here you'll find all our membership benefits. We hope you'll join as a member so we can hustle together and gradually become wealthier. See you tomorrow.